Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action. All right, today we have George Roberts with us from Roberts Capital Enterprises. George, thanks so much for coming on the show. Do you want to just get started and kind of tell us a little bit about yourself and how you got into real estate?
Absolutely. Let's dive right in. Well, first of all, thank you. It's a great honor and a pleasure to be here. I got started in real estate in 2010. I was an accidental landlord. We all remember that was the bottom of the market. And well, thank God that I called it, moved up into a bigger house and decided to keep the old house as a rental. And it turned out to be one of the best ideas ever. We were able to recover the capital, which I really shouldn't call it capital because it was the family home. So everybody else selling their home for half price, we got our money back and more, and had great cash flowing asset. So after that, I thought, wow, this is beautiful. I've got a great career. I was working in data science through most of that time, making just tons of money. But, getting that check every month, that was such a beautiful thing. And when I finally did make the mistake of selling it many years later, I missed it. I realized, real estate really is the place to be. So I used all of that analytical firepower. I surveyed the entire world of assets and investing and decided, you know what, next time we spin the wheel, I want to be in multifamily. And so I decided to turn those economies of scale to work in my favor.
Awesome. That's a great way to get started. Our parents were in real estate and had rentals, but so we are not quite accidental, but very similar to our start. So, but
my father too, but I say accidental because it's a family home, right?
Yeah.
So yeah, parents were very helpful there. Yeah, my father, real estate investor, stock investor, equities, etc. Yeah, big investor.
So you said you were working another job then. Did you start to kind of dabble into the multifamily world, or did you just kind of like jump head first into what did that start look like into
It was a long
multifamily?
period of dabble. So yeah, starting in 2010, I became so that's when I was merging from bioscience into data science. Then worked in that field until I think it was 2021, 2022, something like that. And over that time frame, I just had that one unit. Well, then around 2019, I said, gosh, I've got to get into multifamily. I love this business. Bought my first in 2020, and really didn't have very long. I didn't really have a very long ramp, but when the interest rates increased. I got booted from fintech. They were just cutting people left and right. And I thought, well, hey, I don't really have enough runway to be comfortable taking off, but what the hell? I'm just going to pull the stick and we're going to do this.
So when you said you eventually sold your home, your rental that was your home. What year did you sell it?
That was 2018. I think we did okay. I wish I had a crystal ball. I would have kept it a few years longer, or maybe even still had it. It's I'm like everybody in real estate. So what's your biggest regret? I wish I could have held on to everything.
So you said you went through and analyzed essentially every asset, and that you decided on multifamily. What prompted you to do that? You wish that you hadn't sold you missed the rent check, and then I guess what did you eventually conclude? What made you decide on multifamily?
Right. So there's the economies of scale. There's the semi-passivity of it in the sense that I got this 6-figure plus job. I can't do 100 deals. Okay. I can't be at somebody's kitchen table every night, every week, even every month. It's way too much of a grind. So buy a few bigger deals and then focus on those. So it was really all about remaining a data scientist as long as possible.
Okay.
Yeah, certainly
Okay.
using those skills has got to be pretty useful in doing the analytics of like what to invest in. Like, do you find that it's fairly adjacent to data science?
No, I think everything in life is all about data and analysis. Look, we got to execute, but what are you executing on? The more things that you're analyzing, the better the likelihood you're going to find the right deal, that you're going to pivot when the markets turn. So stay curious. And that was really the first lesson I learned in my career, way back to being a bioscientist. I got asked the question, hey, or no, I asked the question, what makes a great scientist? And I thought it was like an IQ of 212, or that I have to, brush up differential equations. But no, it's to be curious. And it's funny thing is that I think that that really goes for everything in the world. If you're curious, you'll keep learning, and that'll keep you fresh.
I agree. Never stop learning. That's
Oh yeah.
So I guess why don't we go down that thread? What I guess what books or what sources did you find the I guess most information from or were most meaningful during your the time when you weren't learning?
Yeah, I would say that Michael Blanc's book, I think, was very influential to me. I love the way that he just spoke with a great deal of candor, that he started these pizza restaurants, made a lot of money for a while, and then things kind of turned against him. And I really think that, again, the idea is you want to analyze, you want to be ready to pivot. He pivoted. He went into fix and flip and then multifamily. So look, it's a long and winding road, but guess what? There's a lot out there for people who are willing to go out there and pivot. So that was hugely influential to me. And anyways, wherever you want to go from there.
Well, I kind of read a little bit more about your bio and that sort of stuff. And when you started out in multifamily, did you start out as a limited partner investor, or did you just
I should
jump
have.
straight to a sponsor?
Yeah, some people, I don't know what it is, but I just had to get my hands dirty. So it was around the same time I tried both. And I think that I actually started actively predated by at least a half a year to a year.
And like,
Yeah, definitely, definitely don't discount the idea of starting as passive.
exactly. I mean, I think when we started out kind of similar time frame, I think we kind of identified our first one in 2019 and sponsored our first one in 2020, and over the course of 20 to 22, made a couple LP investments. But I was just kind of curious, like when you were looking at those other LP investments, what drew you to invest in passively along with doing it actively?
I think I just really wanted to learn more because I have my finger in more pots, see more deals, and then not have to operate everything. I mean, I think we all want to have our toes in the stand. I just love the West Side Investors Network vibe. I feel a little bit like I'm out on the West Coast when I talk to you guys. So uh, that's really what it's all about. I mean, for me, I want to be on my sailboat. You can see my book here in the background, Passionate Living Through Passive Investing. So that's really what it's all about for me. And in the end game, we all should want to be passive investors. So however you get there, by doing more and more passive deals, or maybe by being an operator for X number of years. Again, don't think of it as necessarily just the starting point. It may also be your end point.
I mean, it to move into the investor box, from
Right.
the W-2 box, that's the dream.
Exactly. To put in Kiyosaki terms, love the guy.
Oh man, we're gonna do a Rich Dad Poor Dad book review for our property management team next month. So
Mhm.
good old Rich Dad Poor Dad, and then some cash flow quadrant.
Yeah, one of the best games ever. The only
Oh,
game that
the
can rival
cash
my
flow.
love for
Yeah.
Monopoly.
Yeah. So when you got started in multifamily, what was it like? And you were working full time, and then what was going full time into real estate like?
Yeah, so it was crazy for a long time. I was kind of full time in both. When I think back to those times, and really those were the great days. I mean, those were the days, 2020, if we realized it, but we didn't realize it. I got my first deal because a couple people pulled out of a deal because of the pandemic, because of this, and actually for other reasons. And then the pandemic came, and we signed closely shortly after. The pandemic was just frightening people from, do we get into this or not? But we were able to find a good enough deal from a seller who had some deal fatigue. So we really took advantage of that. We got into that in a great cost basis, making money, cash flow, appreciation. I mean, really, it was the total picture. And then went on and did a few more deals, kind of like that. And at that point, like I said, it was good and lucky timing that the multifamily thing took off quickly for me because I had no idea that the fintech gig was going to end so soon.
Yeah, and then so was it? I mean, you were doing multifamily full time, and so then and then and then you instantly had another 40 hours a week to work. What was the I guess, but then the market started turning a little bit. So how did that
Right.
go?
Right. Well, I mean, it was only possible with telecommuting. I had two computers open, it seems, all the time, keeping track of my investments and my prospective investments on one, and then just keeping the job on the other. So, in some ways, it was very, very lucky time frame. And then it was just very welcome when I went into real estate full time because, again, then it's not as if I have two jobs anymore, only one and a half as full.
And I don't know if we asked this yet. Where are you out of?
So I'm coming at you out of Michigan, Southeast Michigan, north of Detroit, out by Lake St. Clair. It's beautiful out here. Love our vibe too, our Midwest vibe. We got the Great Lakes, and I get to get out there. I want to say almost every weekend. That was the past. Now I'm busy with other things, but at least once a month I get out on that sailboat, enjoy Lake Erie.
Oh, that's cool. And then are you investing locally or are you looking at other markets? Or how's that working for you?
No, I was investing locally at first, but that was another thing that actually drew me to multifamily, that it doesn't have to be here. The idea that really the entire country is potentially my market, that really appealed to me, especially given that I love analysis.
So where do you like to invest then, or is it a specific thing, or is it just more kind of like deal specific?
Yeah, so right now I like the middle latitudes of the country. I think that's where the better deals are. We all know what happened to the southeast. Hey, I had a great deal in Orlando there, still have it, but I'm not buying in Orlando right now. But I like the lower Midwest, upper South. This is where things make sense. Northeast may be growing, but guess what? I don't like all of the regulations, etc. So, the band where I'm in, where there's not it's not too wild in terms of regulations on the landlords on the one hand, and yet still growing. Steady Eddie wins the race. I'm a Midwestern.
So the Midwest, the I guess we only invest in Portland where we're vertically integrated. I mean,
Right.
I guess we only buy property there. We do passive investments anywhere, but yeah, I mean the numbers. I've analyzed a few deals in Chicago. I've analyzed Cleveland, and I mean the numbers are just so wildly different. Like the expense ratios, and
Right.
I mean the amount of rent per the cost of what a building is. Like it's if you're looking at like 2% rule here, it's an absolute miracle if we get 1% of the purchase price on gross rents for a month. So I would be interested to hear, like how you shift markets. So I guess easily, like we've underwritten Jacksonville, Florida. The expense ratios are just, through the roof there as well. And so I guess maybe we're just anchored to, low expenses here in Portland.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
Hey, let me ask you, what if tax season was actually exciting? I know, it sounds crazy, but not when you've got the right playbook. At mymoneyworksforme.com, we put together the Pro Tax Strategies playbook that real estate professionals use that you may not know about. You'll learn how to crush taxes with depreciation and rep status, how to stack smart write-offs from the Augusta rule to vehicles, and the ultimate wealth hack, 1031 exchanges and vacation rentals. It's free, it's powerful, and it's waiting for you at mymoneyworksforme.com, because your money should work as hard as you do.
I love it. Well, stick to what you know, stay in your lane. It's a great bit of advice. I'm not looking in Chicago, and I have looked at Cleveland. And I did take a pass. When I'm talking about Midwest, again, I'm looking more places like Cincinnati, Kansas City, or some people call Louisville the gateway to the to the Midwest, etc. So those are the sorts of places I'm looking. A lot of the Midwest I wouldn't touch. I mean, we've got other problems here. You're right. It's pretty amazing what you can get, for example, per unit, etc. And people coming from some of these, maybe higher expense ratio places or places where the per unit is just again through the roof. These deals, again, they do look very different, but we've got to deal with a lot of places in the Midwest people are leaving. So again, that's why I like to stay kind of close to the South where people are moving. People are going where it's more affordable. And I think that's really the part of the country that I do believe should continue to expand and should be safe to invest in for some good time to come.
I'm interested to hear more about your thoughts on migration and just like, I did a little market update for our team today, and we essentially were talking about cities, major hubs, and how remote work has devastated the office market downtown in many metros. So are people going to move back to the cities? I mean, are offices going to get converted to apartments? What you mentioned that people are moving to affordability, and I kind of agree with that. We have a lot of people who moved from Portland to Boise, Idaho, when Boise was a little more affordable, but now Boise is more expensive than Portland. And
exactly.
So it's interesting. Yeah. But I mean, politics are way different in Idaho.
Yeah, exactly. It's funny, you cross a mountain range and all of a sudden everything changes on the other side of the divide. But
yeah.
Well, let's see. Getting kind of back to the Midwest migration. I think that's still, yeah.
Yeah, I'd be interested to hear your thoughts on migration and just like where we had a massive move of people to the Sun Belt. Like it was huge, like in 2021, 22. So
Yeah. So
and people are
sorry,
moving
sorry.
away from this.
Yeah, so I think we're still playing out the last trend. Okay, the last trend really was the affordability, still is. Got to keep our eyes on that. I don't know what's going to happen, but I love your insights about people moving out to Boise and that getting, sort of expensive in its own right. And that's happening really all over the country. We had another wave of overbuilding recently, and I think there's another one coming. And it's going to come as soon as the interest rates decline, as soon as lending opens up a little bit. Those builders are going to start building like crazy. Now, where are they going to build? I don't know. That's what we're going to have to keep our finger on the pulse of, because those are the markets that we're going to want to stay away from. I got into Orlando in 2020, massive tailwinds. Now we've got some headwinds, but we're surviving because we bought with a good margin of safety. We bought right, and we're going to be fine. We can hold on as long as we want. We're in no trouble. But yeah, I think people are going to want to shift away from the markets that get built up very quickly. And another way to put it is when the markets do rise like crazy, like Boise, watch out, because people get way too excited. I mean, and it's commonplace. I mean, we all know this, but then why does it happen again and again? Why does human nature never change, even though we see these markets crash? So I don't know.
I mean, as data analysts or like data sciences, like that's a job of like aggregating like tons of data together. Do you use that to do kind of some of this market analysis at all, or?
Yeah, absolutely. I mean, I am on Fred all the time. There's all kinds of amazing things that you can find on Fred. Look at the markets. Freddie Mac is great. They're looking at a couple dozen cities for multifamily. If you can't find the multifamily data, you can look at the single family data and get some basic idea of how the housing market is going on fred.stlouisfed.org. So absolutely, you want to stay agile, and again, just the more data you're looking at, the more likely you are to spot the trends and figure out where you need to be.
Yeah. I mean, it was the interest rate decision today. That's doesn't seem like rates are going to be, at least the Fed is going to be lowering rates this year, sadly. So it's going to be more tough sledding.
Yeah. Inflation's up for sure. So George,
right, at least temporarily.
Yeah. I mean,
hopefully
cross our fingers.
I mean, I've heard some guys say that like this, a stable market is going to be, interest rates somewhere between 4.5 and 5.5. So we might be a little elevated from that, but seeing the sub threes ever again in our lifetime might be a little troublesome. I'm not sure that that's going to happen, but yeah, well.
Should we move on to the 4 questions? Or George, do you want to share a little bit about, your businesses and the goals that you've got for Roberts Capital and Horizon Multifamily?
Yeah, so Horizon's really sort of a thing of the past. I still work with those guys, but Roberts Capital is what I'm doing going forward. We do multifamily. I also do some private lending out in there. That's my main vehicle these days. I want to continue doing these things. Private lending is a beautiful thing. It works really well in your self-directed IRA, great for tax purposes, etc. And multifamily is a great place to be. So definitely not making any major changes there, just barreling forward. Yeah.
So that's interesting. I don't think that we've had anybody on doing hard money lending, especially out of their IRA. Are you doing that?
Yeah, so I mean, I got a couple of larger loans out. It's not something I do all the time, but it is a significant part of my portfolio. And again, you got to remember that the lender always gets paid. or at least they're the first to get paid. If they don't get paid, nobody gets paid. So as you get more wealthy, it's really more a matter of holding on to wealth rather than growing it. And when you look, again, as you go more up and up the scale, it really is totally about capital preservation. So you have to concentrate to grow it, but if you want to keep it, you better diversify to some degree.
Interesting. So, yeah, I'm just very intrigued. We interact with hard money lenders relatively often, like because we buy deals that need hard money lenders. We have 2 deals in contract right now, and we're trying to get $1 million loans, and for properties for 8+ unit properties that need, a lot of work and, currently aren't performing. And so it's just, to have a good hard money resource is huge for us. And then as well, I would just be interested to kind of hear what your long-term outlook is, doing hard money lending. Like, I've always thought that it'd be a pretty interesting opportunity.
I mean, I want to keep in it probably at the same level. So, if something pays off, I may be interested in something new. So, maybe not something I expand, but certainly not something that's going to go away.
Well, how do you identify the opportunities to deploy the hard money lending?
I think there's a lot of pots. Hard to say really, because look, I've got a weekly networking call. I've got a monthly in-person networking in Southeast Michigan. I just talk to people. People say, George Roberts is a guy who knows everybody in real estate. So passive investing, all these ways, I just have my fingers in a lot of pots. So if something makes sense, hey, I'm always hearing about deals. And then people send me their deals. I work with a lot of newer investors, et cetera. So, really, I am a guy who has his eyes on a lot of deals.
So would you say then that most of the hard money lending is local then? Or have you tried out some of the debt funds?
Yeah. So, right. For me, it's not necessarily local, in terms of debt funds. What I'm seeing with that is that, if I was going to invest with someone else passively as in debt funds, it's not very good. I know some people locally whose deals I like. And, if you're working with somebody maybe a little smaller, maybe not a fund yet, you may be able to get yourself 12% plus a point, and maybe they're taking a point. So with numbers like that, I'm really not losing.
Yeah. Yep.
I mean, especially since I just have to vet the deal. I don't have to find it. That's my idea of living.
Yeah, having to find it, and that's where all the work is. So yeah, it makes sense that the broker would get the finder's fee.
Absolutely. I'm happy to give it to it. I mean, if I can get a point out of it too, I mean, that just seems like gravy.
Well, why don't we get on to our final 4 questions? AJ, do you want to kick us off?
Sure. What's one piece of advice you would give to your 25-year-old self?
Don't worry, be happy. It's going to be all right. I've always been a total workaholic, but when you let those worries go, you just relax, take a deep breath, you can actually work a lot harder.
Okay. I love that. What was your first entrepreneurial endeavor?
So we talked about becoming a landlord in 2010. That was really it. It was in a small way. Then in a bigger way with my sister in the family construction company, and then buying that first multifamily. Now that was my big introduction to entrepreneurship in 2020.
Exciting.
And then how has your formal and informal training shaped your journey?
So working as a bioscientist really taught me the importance of curiosity and being a forever learner. And that really continued through being a award-winning data scientist. I learned to grow my love of data and analysis. The more I analyze, better I can pivot and find the right place. It's not all about finding markets, finding niches, right? I like smaller deals. I like secondary markets. These are some things that make sense to me. And again, just Stay curious, my friends.
Stay curious. That might be the title of our podcast. All right. And our last question. What was your biggest mistake and what did you learn?
So like most investors, I continue to buy towards the peak. Now I slowed way down, thank heavens. I showed a lot more prudence than many people, but we all wish we had that crystal ball. And you got to remember, just make deals because they make sense. Don't make deals for ego's sake. Relax. I mean, something we talk about in private equity is deal heat. Recognize that deal heat. And that's when you need to slow way down when everybody else is rushing.
So wait, say that again. Recognize that deal.
Deal heat. So yeah, in sort of traditional hardcore private equity, deal heats or angel investing, they talk a lot about deal heat. So when everybody's doing deals, they're hot to do a deal, valuations are going through the roof. Yeah, we call that deal heat. And when you recognize that you're caught up in the frenzy, take a step back. And it's hard because by definition, this is when everybody else is doing the opposites.
Yeah. I mean, I think that we wish we were selling, at the end of 2021 instead of buying.
Well, I think we wish we were doing both.
I love it. I didn't mind buying in 2021. I think that was still okay, at least, halfway through the year, roughly.
Yeah.
Or hey, if you were getting seller financing, you might have been good even later in the year. A couple of deals in 2021 I did. One was a seller finance and the other one was an assumption. So, if you're doing that, the interest rate environment still really, hadn't changed 2021, even 2022. So it's all about where you're looking. I just try not to run with the pack. That is, if you want to quote, you can't beat the pack if you run with the pack. So, make sure that you are always differentiating yourself.
All right.
Yeah,
well,
I love that.
George, thanks for coming on. I know that you have a book, right, that you wrote?
I do. It's called Passionate Living Through Passive Investing. And what a perfect segue, because pillar one of my method is, that you have to look for opportunities where others aren't looking. So exactly, don't run with the pack. And I talk all about private equity here, not just multifamily. That's one of the things that sort of differentiates me. I'm not just telling people, hey, come and invest with me, although I wouldn't mind, call me. But my second book is going to focus more on what I do as an investor myself, as an active operator. That's going to be all about multifamily. Nice. And actually, by the way, I do talk a great deal about real estate. I mean, to me, real estate private equity is the best place in private equity. I wouldn't be there if I didn't believe it.
Yeah, the thing with real estate that you get is the leverage. If you're in the regular market, the stock market, there's no leverage to your money, and real estate really provides an opportunity through that. Well, thank you again for coming on. If our listeners want to find out more about you or get a hold of you, what's some good way for them to search you out?
Find me at www.robertscapitalenterprises.com.
Okay. Awesome.
Fantastic.
Well, thank you again. Appreciate it.
Great to meet you,
likewise.
George.
Thank you. It's been an honor and a pleasure.
Awesome. Well, enjoy the Great Lakes. Hopefully we'll see you out there sailing.
Yeah, we'll do.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.